All right, let's talk about something that can feel, well, a little complicated: investing. But what if it's actually way simpler than it seems? Our goal here is to give you a really clear, straightforward way to think about how to make your money work for you. So, let's just dive right in.
So, here's the game plan. First, we're going to hit the big why. The invisible force that actually makes investing so important. Then we'll get into your mindset. Are you an investor, a speculator, or maybe even a gambler? After that, we'll open up the basic toolkit that every investor should have. Then we'll figure out how to match those tools to your own goals, and we'll wrap it all up with a simple 5-step roadmap to get you started.
Okay, first things first. Why are we even doing this? Why not just pile up your money in a savings account and just call it a day? Well, the answer is actually a lot more urgent than you might think.
Here's the hard truth. Any cash you have that's just sitting there, not doing anything, it's actively losing its buying power. It's kind of like a slow, silent leak in your financial bucket. And the culprit behind it is a word we all know: inflation.
At its heart, investing is just a trade-off. It's like having a seed. You can either eat it now or you can plant it. You're giving up a little something today, postponing that purchase because you fully expect it to grow into something much, much bigger for you down the road. It's the choice between enjoying something now or enjoying something even better later.
This idea is something called the time value of money. And it makes perfect sense, right? If you're going to give up the certainty of spending a rupee right now, the promise of what you'll get tomorrow has to be better. There has to be some kind of reward, a return, to make waiting worth your while.
Okay, this chart right here shows the hidden enemy of anyone who saves money. So let's say your savings earn an 11% return. That sounds great, but what if the price of everything, gas, food, you name it, also went up by 11% that same year? What did you really gain? Exactly, nothing. Your real return is zero. You're just running in place. To actually get ahead, your money doesn't just need to grow, it has to grow faster than inflation.
So once you decide, okay, I'm putting my money to work, your approach becomes everything. Your mindset, whether you're acting like an investor, a speculator, or a gambler, is going to be what really shapes your entire journey and your results.
So what's the difference? Well, you can see it right here. It really comes down to time and expectations. An investor is playing the long game. They want solid, good returns over many years, and they tend to be pretty careful. A speculator, though, they're in it for the short-term rush, hoping for huge, abnormal returns really fast. And to do that, they have to take on a whole lot more risk.
And then you have gambling. And this is in a completely different category. See, investing and even speculating are based on the chance of a positive return. But gambling? It's designed, mathematically, for a negative return. The whole system is built so that, over time, it's supposed to take your money, not grow it. The odds are against you from the start.
We've all heard this saying, right? It gets right to the point. That negative expected return means that while one person might get lucky and win big today, the system itself, the house, is guaranteed to make a profit in the long run. It's not a wealth-building plan for you.
So this table just lays it all out perfectly. The investor, long time horizon, lower risk, positive expected return. The speculator, short time horizon, cranks up the risk for a potentially positive return, but it's way more uncertain. And the gambler, super short time, super high risk, and a mathematically negative expectation of return.
Okay, so we've got the mindset sorted out. We know the why and we know the how. But what about the what? What are the actual tools, the building blocks that investors use to build their financial future?
First up, we've got stocks. And honestly, the easiest way to think about a stock is that you're buying a tiny, tiny piece of a business. You become a part owner, which means you get a slice of that company's future profits and assets.
And then you've got bonds. Now, if buying a stock makes you an owner, buying a bond makes you a lender. You're basically loaning your money to a company or even a government. And in return for that loan, they promise to pay you interest and then pay you your original money back at the end.
But what if you don't really want the headache of trying to pick the winning stocks and bonds yourself? It can be a lot of work. That's where mutual funds and ETFs are absolutely brilliant. They let you pool your money with a bunch of other people to buy a whole basket of different investments all at once. It's pretty much the easiest way to get instant diversification.
Okay, so now we have the tools. But which ones should you actually use? Well, there's no single right answer because it all depends on your personal investment compass. What is it you're actually trying to accomplish?
Generally, your strategy is going to focus on one of three main jobs for your money. So, is your number one goal just safety, making sure you don't lose the money you put in? Or is it all about capital gain, growing that nest egg as big as you can over time? Or maybe what you really need is income, a regular stream of cash flow to help pay your bills.
And honestly, this might be the most important thing to get. There is no such thing as the best strategy for everyone. The right approach is always a personal mix, and it's tailored specifically to your goals, how much time you have, and this one's a big one, how much risk you're comfortable with. How much sleep you're willing to lose when things get a little bumpy.
All right, let's put all these pieces together into a clear, step-by-step process. This isn't some secret formula. It's just a logical roadmap that can help guide you through your decisions from beginning to end.
And here it is. It's a 5-step loop. Step 1, you figure out your goals, just like we talked about. Step 2, you look at different investments to see what fits. 3, you put them together to build your portfolio. 4, you check in on it from time to make sure you're still on track. And 5, you evaluate how it's actually doing. Then the process just starts over. It's a continuous cycle.
So there you have it. You've got the why, the mindset, and the tools. You have a framework for thinking about your goals and a process to put it all into motion. All the pieces are right there on the table. So, the only question left is the one on your screen. Your investment journey starts right now. What's your first step going to be?